You're listening to the RE Social Podcast with your hosts, Andrew and Vince from OnV Invest. For more information, go to onvinvest.com.
What's up, you guys? Welcome to another episode of RE Social Podcast. And I'm going to try to pronounce Randy's last name. We have Randy here. It is Langenderfer.
That was it. Langenderfer.
With a name like that, Vince, I'll answer to almost anything.
Yeah.
Love it. Well, pleasure to have you on, man. We're excited to dig into your story and help to educate and inspire our listeners. Thank you, everyone who is listening. We really appreciate you. Let's crack it right open from the
man. For people who don't know, I usually try to keep a timeline of how you've get in the game and then what you're doing now and what your properties and all that stuff. So for people who don't know, I know you're with InvestArk Properties and you guys have like probably thousands of doors, but give a little brief intro, 90 seconds.
90 seconds. Randy Langenderfer, Houston, Texas. My wife always says I talk too much about business without giving some personal stuff. So father of 4 or 5 grandkids. Been doing this 10 years, started out as an LP, became a GP in 18. I've got about 1,500 doors as a GP and I invest in other people's deals. I've got about 3,000 as an LP and left the corporate world a year ago to do full-time real estate. Did I do it in less than 90 seconds?
Yeah. No,
that was like a personal record.
You have like 45 more. You can keep going. That's cool, man. Yeah, for people who don't know, LPGP means a limited partner, general partner. So Randy, Drew, me, myself will be considered like GPs, and people who just invest passively, they're considered LPs.
So you start off as an LP, you said, and then eventually we're like, hey, I want on the other end of that deal and started doing your own deals as a GP.
Yeah, my journey kind of started 10 years ago when I was working a corporate job. I lived in Cleveland, Ohio at the time, and I worked for a private equity company I was coming out of the 08-09 crisis. And at that time, I had an aha moment in my personal life when I realized I really needed to find another income. This corporate thing, thought I was going to be laid off at any time, not for performance-related issues, but for financial issues. And so that's when I made a very conscious pivot to find another alternative income. I started looking at small businesses, franchises, started out doing single family hard money flips and got into it that way. Moved to Houston, Texas for business and found multifamily. And when I attended big educational group here called Lifestyles, and then was part of Brad Sumrock's and part of Rod Khleif's organizations. So a lot of different educational come in. But when I learned the concept of non-recourse loans, that we could buy multi-million-dollar assets without having to put anything really personally in them other than the investment we made. They couldn't come back against us if it really failed. That was a second aha moment. And I said, because anything else you buy, small business, franchise, they're all personal guarantees. And I just did not want to do that. So I fell in love with multifamily. Here I am.
And so for the dummy in the room, me, what is a non-recourse loan? I know my lane very well, but I'm not super educated on what that is. So between you and Vince, help me out.
That's great. So, when you buy a house, right, you sign personally. So in the event you default, they can come after your cars, your investments, any other assets you may have. That's called a recourse loan. It is the loan, your house loan is secured by your income and by the property as well, but primarily your income and your other assets. So a non-recourse loan means that when you take out a loan for a $5 or $1 million or $10 million property, the loan is secured in the lender's eyes by the property itself and the income it generates. And thus it's a non-recourse loan. So when I sign on a loan as a GP to buy properties, we always have non-recourse debt, meaning that if the absolute worst were to happen and all the tenants move out at once and we got no income, the bank can take back the property and I would lose my initial investment, but they don't have the legal right to come after my other assets.
Got it.
That's called non-recourse.
And that's
Big
pretty
deal.
traditional with multifamily?
It is a very unique differentiating in multifamily compared to strip centers, office, warehousing. It is very unique. And that is a big differentiator and that's, why people like it.
Yeah, I can see the appeal. Now I'm sure, let's go way back then. Was your first buy in this kind of category, some multifamily? Was it a single family home? What was the first move you made?
So the limited partners, or LPs, as I refer to them, that Vince talked about, is really you have no legal liability, and so that's why I made the first of my many investments to learn the process as a limited partner, where you're investing money in someone else's deal. The general partner or the GP is the one that has all the operating control, makes all the decisions, deals with the property manager, put the deal together, raise the money. They're the general partners. The limited partners or the LPs are just the investors. They put their hard-earned money at work and are expecting a return. But they really have no risk at all as a limited partner, other than the money they put down as an investment. So I put my first several investments, I got in as a limited partner because I wanted to learn the business. I wasn't part of one of the big educational groups that was charging tens of thousands of dollars for education. The advantage of the limited partner is their risk is limited to their investment only. And so the first couple of times I was so risk adverse, and I just started out with investing with a partner, and we combined put $50,000 in a multifamily, $25,000 each, because I was very risk adverse. But the point of it is the limited partner has just that limited risk to their investment, and the general partner has a little more risk in that they put money up front for the loan and all that stuff, but they can't come after their personal assets, and that's a distinguishing factor from any other kind of real estate investment that I know.
Yeah. So, I mean, for people who are listening, that's the big difference between agency debt and going into non-recourse. You pay a couple of additional points and different things, but it turns out there's different risk profiles and stuff. So that's really cool, man. So you got into LP situation, the first deal, right? And then did you do another LP?
Yeah, I probably did 3 or 5 LPs before I really got an opportunity to jump into the GP side.
So it was the same company each time, like the same group?
No. As a limited partner, I had decided. So my corporate background is in risk mitigation. I was a VP of corporate compliance and privacy and blah 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 for an academic medical institution here in Houston, and I was risk is a big topic in my mindset. And so my thought process was to diversify my risk by, as a limited partner, I invested in several different people's deals and geographically dispersed as well. So Texas, one in Houston, one in Dallas, another one in Ohio, each with different general partners. And then when I did my first general partner deal, it was in lovely Beaumont, Texas. For anybody that doesn't know where that's at, it's about 100 miles just due east of Houston, right on I-10 between us and St. Charles, Louisiana.
I was gonna say that's got to be almost Louisiana territory, huh?
Yeah, it's real close to Louisiana.
Wait, I missed. Did you say you were still in the LP game, or now you're on the GP side? You're still in the LP.
My first GP deal was the one in Beaumont, Texas.
Okay, so I want to ask you about that though.
Okay.
So you've spent some time with assuming Rod Cleef, and I know Rod Cleef. I've met him a few times. He's cool. I've been to his seminars and stuff.
Yeah, very cool.
Very, very nice guy. He lost a bunch of money during 2008. So his whole thing is like now multifamily, no single family crap. Brad Sumrock he's pretty famous in Texas also, educator, multifamily guy. So you were doing LPs kind of deals with these guys first, students of theirs?
Students of theirs, not them themselves, but students of theirs. And mostly Brad's group at that time. I hadn't gotten involved with Rod yet at that time when I did my first GP, but they're students.
So my quick question here is, what is that education process like when you're on the LP side? Like, let's help our listeners to determine if they're getting started. Should they follow that route? Did it work out for you? Do you regret anything? Do you wish you just went and paid for coaching and went GP right away? Where your head at?
That's I think most people when they start, they either want to start very small and buy a duplex, or they want to start out in something bigger. I wanted to start out in something bigger. I did not. Years ago, my first house was a duplex. And at that time, I made the decision I never wanted to be a property manager again. So I wanted a bigger unit, and I wanted to partner with people that had gone before me to, again, reduce my risk. And when I did that, these big educational groups, Sumrock, Lifestyles, Belief, Michael Blanc, Jake and Gino, there are many of them around the country that all have a similar model, and they're fine. They're going to have an intro seminar with several hundred people, and they're going to try to entice you to join their private mentoring group, which can be tens of thousands of dollars. When I was doing it, it was $28,000 to join their personal mentoring program. So there's advantage because to joining a group, because you get the value of networking, you get the experience of that mentor, coach, the group. You get their Rolodex, you get their experience.
They're vendors as well.
Say it again.
They're vendors as well. So
they're vendors. They're vendors. You know, it's instant credibility to say, "Hi, I'm Randy. I want to buy your property." And a broker would get very nice, but who's Randy? You can go, "Hi, I'm Randy, and I'm part of Rod Khalif's group," and bring, he's a personal coach of mine.
Yeah.
It's a huge difference.
But you did not take that route.
I did not. I was able to partner my first time with some people that had already owned the property. And so I came in as a partner, and we got baptism by fire, because the property had a fire and it was a train wreck. But I got on the loan, and I got into it because one of my partners had already done a deal. And so that's another common way to get started. This is very much a team sport, as you guys know. It takes a team of individuals.
So how are you picking out information? Because an LP is like way more passive, like so passive that you could literally know nothing and just collect a check and a little of the equity at the end. So how are you getting that education?
Yeah. So when I started, I was, like I said, I was kind of stubborn. I didn't want to pay the large entry fee into the large group. And so I talked to sponsors, and I just asked them, I said, "Hey, look, I really want to do what you're doing one day. Do you mind if I ask questions along the way? I'll do free work for you. I'll go out and do part of the unit walk for you for free. Or you tell me if you want somebody to go out and do a site visit, I'm there for you. I'll drive 100 miles to Beaumont." And you got to really find the right person to work with. But I just said, "I'd like to tag alongside of you, however I can help you." And they were very gracious. They let me tag alongside. I didn't try to be overbearing, but I would call periodically with questions once we acquired it.
Nice. That's a clever move. Yeah. Cause I mean, you're already, cash invested. They see that you're already bringing that. And so there's a lot of value, and they want to take care of you. And that's kind of definitely an unusual route, but I think that's brilliant. I'm thinking about it. And, as we are always having partners come in with a lot of capital, if somebody said, "Hey, I'm excited about these last couple of deals we've done. We're up to $100,000 in. Can I pick your brain just for like a couple minutes? I was looking at this deal." I'd be very happy to take that call. Like, "Oh yeah, totally." As opposed to if somebody who was just kind of random, even just a friend of mine, which happens all the time. "Hey, can I talk to you about Airbnb?" And I literally go, Yeah. I'm gonna give you like 2 minutes. Like, what do you got? Where are you at? And usually they're just throwing buzzwords out there, just enough to get hurt. I can tell that's all they know. So the point is I don't take anyone seriously unless they're like, "Yo, skin is in the game." So that's a very clever move.
I'm going to invest in your deal. You're more willing to talk to me than somebody who's not. And if money talks. So It shows sincerity. It shows interest and willingness.
It's definitely a clever move. Maybe it's not as a direct of kind of education. You have to be a little bit more slow played about it. Yeah. But you're also getting the side benefit of now you're an LP, and as long as that company is successful. So it's kind of a nice little clever win-win that you set up for yourself. Let's fast forward though into Beaumont. Like, what gave you the confidence to get into your first deal as a GP?
I think I would like to say that I was really smart, but I would say that I was just blind lucky because I had a couple of guys that had done deals before, and they graciously allowed me to come alongside of them and join. Ended up becoming kind of the managing member at the end, but it was just an opportunity that came to me. I had a full-time job and I was investing passively, so I didn't really have a lot of time to go chasing brokers and chasing deals, and then put a team together to acquire that. And when you get in a network, you got to just make your intentions known. Hey, I got money, I want to invest. I got money and I want to be a GP. And if you are tactful about that and sincere, I think people respect that. And so they asked me to join them, is the short answer. And I did. And it was just through networking, good old fashioned networking.
Like an event or?
A series of events. So it was at the time I was in the Sumrock group, and his meetings were in Dallas. I live in Houston, so that's a 4.5 hour drive. So I ended up two of my partners were here in Houston, and we rode together in the car to the Sumrock events in Dallas. 4.5 hours one way, 4.5 hours back. You get to know people, and you get to find out what makes them tick, and you get to learn a lot about them. And it just became, they found this deal and they started talking to me early about it. We started talking about financing. We started talking about property management. We started talking about all the things that we were learning at the time.
That's great. And do you still own this particular property?
No, sir. We sold it 21 months later after doubling investors' money.
Wow. That's great. And hopefully pocketing a good amount yourself or taking all the risk.
And made a very healthy gain ourselves. Yes.
That's quite unusual. I mean, it's technically your first real deal in my eyes. And sounds like like what you're saying, you were smart or maybe lucky, maybe a little bit of both.
So the deal parameters, you guys will laugh at me. It was in 2018, it was a 1969 build, 139 doors, flat roof, chiller boiler system. Okay. And I remember one of my mentors, one of my colleagues at the time was saying, Randy, don't do the deal. Chiller boilers and flat roofs are nothing but problems. It's going to cost you. You better have a lot in capital reserves. Mm-hmm. And I was extremely eager to do a deal. And so we did it against that. And 2 months into the deal, I get a call in the office that says, hey, Randy, the building's on fire.
We laugh heartily because we're just like waiting for there's always a thing, like there's always a problem. I love that my joke is like, I'm a firefighter. Like I'm always putting out fires. So it's like what you do as an investor or an entrepreneur. You literally had to put out a fire.
Well, yeah, I didn't physically go out and put it out, but I'm like, oh my gosh. Watch it tonight on the nightly news, the local TV station is here to go. So that was the first big element in the deal. We ended up, at that time you learn what you know now that you didn't know then. It's all about the tenants. You got to take care of the tenants. So luckily, American Red Cross came out and finding housing for these people as they're displaced and helpful there. And luckily, it only took out 28 of the 139 units.
Oh, lucky! How lucky!
Everyone listening is like, only 28 homes. Okay. So, well, let's pull out and extract some of the education. What did you learn from that deal? What would you have done differently? Even though you walked out clean, what would you have done differently to make it even better?
Well, the story gets thicker. What I'd have done different is the fire was one thing, but I don't know if it was slightly thereafter, we realized we retained the existing property management company to run the property that was there before. And there was a lovely, sweet lady there who was the office manager, the property manager, and she had literally lived in the property 25 years.
Wow.
She had raised her family there, knew all the tenants by name, knew where all the skeletons were. And so what we learned, the biggest lesson was she was afraid and didn't want to raise rents on the tenants because she knew them. They were personal friends of hers. So we made the decision very quickly to remove her and get another one in there, and then finding another one and finding another property manager was extremely difficult. Lesson number one is a good property manager. And you really don't know a bad one until a good one, and you don't know a good one until you've had a bad one.
Yeah. So would you have kept her on and maybe had that hard conversation, or?
Knowing what I know now, the lesson learned is the red flag should have been, she'd been there 25 years. And is she really capable of the change we were talking about? And we were trying to be good citizens and not displace someone from a long-term job. But in retrospect, that should have been a huge red flag to us. Live and learn.
Yeah. So what was the takeaway then? What would you have done differently? How would you have screened and looked for the new property manager?
We would have, in retrospect, I would have changed property managers upon takeover. And, at that time, there was a lot of different, Beaumont's a pretty good sized city. It's about 250,000. There's a ton of apartments. It was just a matter of marketing and finding a company that has experience in Beaumont and has experience in a Class C property that's chiller boiler. Interviewing them, asking the tough questions about their experience, about their turnover, how many different property managers report to a single regional manager, what kind of back-end systems do they support in terms of financials and rents, and chasing KPIs, key performance indicators on anything from lead funnels to maintenance requests. And those are, now that I've been doing it for a long time, it flows much easier to evaluate one. But there are a lot of things like that you can do.
Brilliant. I mean, that's what you just said that's worth listening to the entire podcast right there. Just, hey, check, like go back, write down what he just said and make it a checkbox going forward when you go to interview and if you don't know what those terms mean, Google them and then, educate yourself and then start getting in the deals, because hiring the property, everything's people, from the tenants to the property manager, to the handyman, to the cleaner. People, you got to find the right people. It's easier to change people than to change people. I saw Rich had a post on that.
Yeah.
Finding the right people is huge, and take your time and ask those hard questions. Dig in deep. Don't waste time. And I think people who are at a high caliber will respect that.
Talking about, sorry, go for it, Randy.
No, I was just going to say, you guys know this, but we tend to be deal chasers. We love chasing the deals and finding the deals and closing on them and stuff. But the real asset improvement is made in the property management, and we buy $1 million operations, and we turn them over to a $40,000 or $50,000 employee. So there's got to be a lot of oversight there. And I'm sorry, I interrupted you, Vince.
No. I was just going to say, talking about education, I know you're involved with your buddy now. Do you guys think that, what you've learned over the years, you're able to now give that to people? Is that like the goal of that?
Yeah. And so just for the listening audience, I was telling them before we aired that a friend and I started a mentoring business called Multifamily Maestros.
Mm-hmm.
And we're trying to differentiate in that there's a ton of educational mentoring programs out there. But I think what we're trying to differentiate is a real much more smaller audience and more human interaction with us ourselves who've been doing it for 10 years versus in the big groups. You get one of their disciples, usually talk to the head honcho. And we've got 30 plus different modules online that people can go through at their self-pace and get to join a weekly group mentoring call where we go over anything that people want to talk about, as well as meet with them personally. So I'm trying to add a much more personal approach, hands-on approach than one of the big boxes, but it still requires somebody's got to want to do it and spend the time to be successful.
Yep.
What does something like this cost? Like $100,000 a month? What's going on with these?
I like that number.
Yeah, it's a good number.
I like that number.
Yeah.
So we tried to price it very differently for your audience. So I got a deal for your audience right now. So we price it that if for a year's program, for the online tools and the weekly mentoring calls, we priced it $79.97 for a year, and you can pay in monthly installments. Totally up to you. But for your listening audience, what we want to do is offer your audience, they can have a 30-day trial basis where they can get access to part of the tools and join the mentoring calls for only $197. So we can contact me later. Love to talk to you about it if you have any interest. But the value is really in education. I said, I'm a graduate student. I got a CPA certificate. Bob doesn't mean anything, but other than I took a lot of tests. And people invested a lot of money in their college and trade school educations, and some balk about. They're going to invest, as you said, hundreds of thousands of dollars over your real estate career. You might as well get the education and the group to help you prevent making the mistakes that I've made and others have made too.
Yeah, that's something I always say is I would have done one thing differently, and I would have been like way more aggressive in finding mentors and education. I mean, despite, Vince and I reading voraciously and talking to a couple buddies who had done it, we still made quite a few mistakes, which is why we also mentor as well. Because my whole thing is like, I just don't want you to suffer like I did. That's all it is. Like, I want you to win, because there's plenty of gold out there to be mined. It's just, there's a lot of ways to make mistakes and lose your shirt, unfortunately. And your uncle's going to tell you not to do a deal. Your friends are going to tell you not to do a deal. But if you have the right education, you can make the ugly deals look pretty, and you can walk out in 21 months with a nice little cash flow, despite an actual fire, it sounds like.
There you go. Yeah. And it's valuable. So people should really, and not with me, with whatever, anybody else, but I say, I can't guarantee you success, but I will guarantee that you're not going to make the same mistakes I made.
I like that. That's honest. Yeah, that's great. And I'm so sorry, real quick. It's priced at what?
$79.97 for a year. $7,997.
Gotcha. And then the special price for our audience is a free trial.
$197 for a 30-day trial basis.
Got it. Okay. Wonderful. We'll make sure that we put that in the notes.
That's a pretty good deal. I should just jump in on your calls just to see what's going on.
Yeah, 100%, man.
Yeah, that's kind of cool.
I want to learn too. Yeah, we're definitely in the more of the residential 2-unit, 3-unit, single families even. And so we haven't actually gotten to the big multifamily stuff, quite yet officially.
You will.
Yeah, we actually did. I did do a deal with some of the guys from Jake and Gino. And I own a apartment building. It's like, I think I have like 1% ownership or something stupid. Yeah. But it's a GP situation in Lakeland. Noah's in it too. Yeah. But it's a lot of work, man. It's just, I just didn't like it. I don't like it.
How many doors?
What's that?
How many doors was it?
It's 44 doors. I think we bought it for 6. I think it's bought it for 6 something. Yeah.
But you hit the head on it. You're right. There is the differentiation. So I talked to a lot of students, and I said, you either want to. So I own 1,500 doors. I don't own 100% of it. I got a fraction of it. Yeah. And so I own a little in a lot of different things. Some people want to own a lot in a little. They want to go out and buy that duplex or that quadplex. I say there is as much work to do in a 44 unit as there is a 400 unit.
Yeah.
You might as well get the economies of scale and go for something bigger first and team with somebody. And it just depends on what you want to do. But either way, whether you're buying the duplex or you're buying 100 units, process is the same.
Yeah. Process is the same. I think for people, it's good to know like what you like to do, what you want to do, what you enjoy doing. I really don't like C-class and stuff. That's how we started. We started with Bakersfield. We had a big portfolio there. I think we had 30 to 40 doors there. We sold all of it. We just sold our last triplex last month. So we're completely out of that game. So now we only buy like in Tennessee and like Orange County, California, where we live. Nice A, B plus A neighborhoods. And, we furnish it and rent it. That's the kind of business model that I've come to enjoy. A little bit more management, but we hire that out. We have our friends.
But again, it's about the people.
Yeah.
You're just getting a better caliber of people. It is what it is. We've tested it. And when there's bars on the windows, you're dealing with people who are going to send the rent check, maybe, but then they're going to have a complaint, and then it's a whole headache. It's a whole slew of things. And our first deal, we actually inherited it was a triplex. On the right side, it was an actual meth dealer, like not a joke. Yeah, so that was fun. And then on the left was some family that just had 1,000, complaints once they found out I was the owner. Yeah. And they were the ones who sent in the first month of rent. And we were like, we're investors now, And then literally it was like the next day it disappeared and it was retracted. I didn't even know you could do that. Yes. I'm not even
close. How do you do that?
I know. I didn't know that was a thing.
They claim fraud to the bank and the bank.
Yeah, something like that. The point is we had 2 evictions going very quickly and got them out, thankfully. But yeah, education is everything.
Took 6 months.
I kind of want to go back and please, if you got some questions, I want to kind of keep following your journey, taking little educational nuggets out of each. So Beaumont, what was the second deal? And did you buy it before selling Beaumont? Or that first property in Beaumont, or
no? So we bought Beaumont early 18, sold it about the end of 19, and I still I took my IRA money from my employer, and I was investing all along in other people's deals. So as I did that first GP deal, I continued to invest as an LP in other people's deals. I wanted to get a broader spectrum of my learning from rather than just that one I started out with several years before to I learned from dealing with multiple general partners, the differences between how they communicate with their investors, how they operated, their assumptions going into the deals. And so I think that education of an investor was invaluable, just continuing to ask questions and learning from them. And there's an absence between the end of 19 and then our second deal was 21, the end of 21. We bought with a group of people, a large Class A property in Weatherford, Texas, which is out west of Dallas, Fort Worth. It had just built in 2020 and we bought it at the end of 21 and it's a beautiful operation. And then bought a couple other in 22, one in 23, and doing a build to rent operation with partners in Melissa, Texas, up north of Dallas. So
interesting. And how has Dallas been treating you overall with appreciation?
Dallas is a great market. I mean, everybody is kind of attracted to Dallas. The macroeconomics can't be beaten. Income growth, population growth. Texas, I came from Ohio 11 years ago, and it's just everything you read. It's crazy growth, and the economics here are, for real estate, just crazy good.
Yeah. I've been in Dallas a couple times, and I've got some friends who are just north, like the Frisco area, and I'm just every time I'm there, I'm watching it's like a different town. It's like it's growing so fast, so rapidly. So.
The city of Melissa that I mentioned is up north. I think it's north of Frisco. I know that it's probably 35 miles from downtown Dallas, and probably in traffic an hour plus commute. So if you live there, it's a fairly new community. But your point is, it just keeps expanding north in Dallas. I don't think I saw a building older than 5 or 7 years old. Yeah. I mean, it's crazy. Brand new high school, brand new strip centers, everything.
And that's been our most recent best play we've ever done. That's our bread and butter right now, and just checks all the boxes. Is just investing outside of a rapidly growing city that is right now Nashville. We're not in Nashville, but we're just outside of it, and that where the population just keeps growing out. There's only one way to keep going because it can only grow so fast to go up. So it's been treating us very, very well. That spillover is amazing. The demand is amazing. We're very picky with our tenants because we can be, and I like that.
Are you north, south, east, west of Nashville?
Just north.
Just north?
Mm-hmm.
Yeah, that's a great
Hendersonville,
market.
Gallatin.
Yeah.
Yeah.
It's been treating us very well.
We'll be
I was
probably
just-
doing
I was just in Nashville about 3 weeks ago, and
nice.
it is like you said, off the rails growth.
Yeah. And I love that city. That's kind of what happened is I went there for a birthday, had a blast. My boys were with me. And then by coincidence, had a friend who was doing some deals there. We somehow came up, real estate, what? And then we just started getting involved, and it's been just, now we're like, oh, okay, cool. Keep going, keep pushing that button. That button is feeding the monkey. So it's been great. And it's great because then I get to go out there, and I do work really hard when I'm there. I'm touring a lot of properties and meeting vendors. I'm buying lunches for my team. And I'm also able to have fun. We have a coaching client, this guy who actually drove out, met me there. I flew in. He's a crazy person. Drove out. He had just signed up as a student, and we had a blast all day. I'd work him to the bone. We'd be watching properties. Check this out. Look at that. Talking. I introduced him to some of my team. And then, little quick power nap, and hey, I'll see you in downtown. Let's just go see. I just want to show him, let's go see Broadway. You just got to experience it once. Go to Tootsie's and watch the singer get on the bar. It's, it's kind of part of I like to have a little bit of both. I like to just work. Let's work hard. Let's play hard. So it's
the touristy thing to do, but dude, you're way too young for a power nap. Come on.
Oh no, I'm almost 40, man. I'm almost 40. Yeah. And when you're walking those properties in that heat all day, and working, and I'm like, give me 20 minutes. I'll be right back.
That's funny. It's all good though.
Have you thought about investing in real estate and taking advantage of all of those benefits without any of the work? That is something that OnV Invest not only provides, but has been providing since its inception. With friends and family, we have built an empire in a system of a wealth generating tool that is giving us and our friends and family that leverage in their life to create true wealth. Go to onvinvest.com for more to see if you qualify. And thanks for listening. But yeah, Dallas is also amazing. So, but back to that second deal, that was, I'm so sorry. Where was the second deal?
No, that was in Weatherford, Texas. And, again, it was a large deal. It was 396 doors. I think it was a $75 million buy. So again, I'm part of the GP team, but at that point, for a big deal, I'm one of about 5 general partners. And so, at that point, there's different roles you take on. You can be the asset manager. You can be a fundraiser. You can be a key principal on the loan.
Which one were you?
I'm part of the asset management team, and I was fundraising. And on that one, I did not sign in the loan, but others I have. So
nice.
So for people listening, I like to break down numbers. That's like my thing because I'm a nerd. So you got a 396 unit building. So I'm assuming, you tell me if I'm wrong. Okay, you're gonna do a pref return for your investors. It's called a 70-30 split.
A 70-30 split. I think it was an 7 or 8% pref.
Yeah.
Yep.
Very, very skewed towards investors. It's crazy. We have a lot of investors. I do no pref. I say, good luck. Like, I'll give you money if I can.
We have a very different model where it's like relationship built, and we take care of everybody no matter what.
Yeah. We do different. We do tenants in common. So if they get direct ownership.
Sure.
Oh yeah.
But then, so you're getting about 20% of the 30%, right? That's will be your share if you're getting a fifth of the GP.
Yeah, it just depends, but yes, that's the general rule of thumb.
That's not bad.
Yeah,
no.
For a 400
massive
units.
deal. And how much was that? How much was the purchase?
Don't hold me, about 75 million buy.
Got it. And then let's talk about like some of the highlights and maybe even the fun stuff, the low lights throughout that deal.
So the fun lights is when, I took my wife to see that first property in Beaumont I told you about.
Mm-hmm.
And she went, "Ew, you're going to buy this?" And
C-class, say no more.
Yeah. C-class, 1960. "Ew, you're going to buy this?" And I said, "Well, honey, we're not going to live here. We're going to invest here."
Yeah.
But conversely, when I went to Weatherford, brand new building, 9-foot ceilings, I could live there. I would live there if I needed to live in that community. I mean, so it's just a beautiful asset.
It was what year was it built or remodeled?
2020, and we acquired in 2021.
And you still have it?
Yes.
Yeah, you probably got like a 2% interest rate on it. What do you got?
No, regrettably, we have a floating rate debt on it, and that's killing us right now. But we're surviving anyhow.
Oh, so you didn't have any insurance or anything on it?
We have rate cap
caps.
insurance on it. Sure.
Oh, you do?
Yeah.
You protected somewhat, right?
Absolutely. Yeah, that's the only way to do it. So if you bought anything in 20, 21, or 22 of size, I'm sorry, 21, 22, or you bought it on a variable rate because that was the only way deals were closing at the time, big deals.
Yeah.
And so investors, have to make sure they're aware of that. And that's turned 180 degrees today. You don't buy anything on variable rate debt today.
I was going to say there's not like a fixed rate period. It's just straight to variable. Like good luck.
Yeah.
Okay.
Well, it's variable. So what they are is they're notes that have a cap on them. So it's called rate cap insurance. And so for your audience, what that is insurance. So after the interest rate went up 2%, this rate cap insurance kicked in and pays us every month for the difference between our loan plus 2% and the market rate, which today is unbelievably, we're thankful we got it because we'd be dead without it.
And how are these insurance companies surviving? They should be bankrupt by now.
I don't know.
Ponzi scheme.
Yeah. I think
Shell game.
doesn't like, there's no way.
I'm glad it's helping you, man. Yeah, that's nuts. That's something that's kind of scared us, to be honest, with the multifamily, is all of that. You know, it's very much this variable rate. And obviously 08 happened and, you know, we all saw our family, and I've got friends to this day who are like, still like kind of trigger shy and you know, cause I'll talk real estate and like, then they'll be depressed cause they lost their home. And I get sad and it reminds me like, oh, that's right. Those variable rates can eat you alive, you know? So we've been very, you know, hesitant. It's really a matter of time. Like you said, what advice, just selfishly speaking, would you give me and Vince on getting into a multifamily?
Join the class on Tuesdays.
Yeah, that's it. For $197, I'll help.
Multifamily
I'll Venmo you right now. Hold on. What's your
buy me a cup of coffee next time I meet.
Sold.
I'm not only good, I'm cheap. I think the advice I would say is one. It suits my personality. As I said, I started out in single family flips, and it's just a whole lot of work. And I own a 60 unit building here in Houston. And I spend more time on that than I do any of my other properties. To your point, it's just a lot of work, and that's okay. We own it with partners and stuff. But so I think, to me, I just keep going back. Once you see the multipliers of money of the multifamily, and you just get a much bigger return quicker if you stick to the principles of buying good areas, use fixed rate debt. Don't use variable anymore. Get debt that matches your business plan, 5, 7, 10 years. Buying good areas, pay a healthy price for it. Don't overpay for it. Hold it. You operate it, manage it well. Improve your NOI because it's forced appreciation. That's the beautiful thing, as we know about multifamily.
That's perfect. I wanted to go into that for our sake and more for the audience. How can you force that appreciation? How can you improve the NOI once you're in?
So just for the listening audience, you buy a house, right? My house where I'm sitting right now, my primary residence, the value of it is based upon comps, what other houses sell for in the neighborhood. So if I have the nicest house in a bad neighborhood, it's kind of a disadvantage to me. Conversely, if I have the worst house in a nice neighborhood, that's very good for me because it gets pulled up by the comps.
But how about if you put in a big luxury pool and spa? What's happening now?
Yeah, that, in your house, you may get more for it, but you're not going to get every dollar back that you put into it, right? So generally speaking, you're not. It's possible.
You're still limited by the most recent, sold properties around you.
And we experienced that with to sell 2 properties right now.
Yeah, we had a single family that was converted to a duplex before we bought it, purchased it in this rapidly growing area, and pretty close. And we tried to get a reappraisal, start talking about bringing the mortgage down, talking about selling it. What can we get? And it came in embarrassingly low. We were like laughing, but it's because of just the lack of comps of duplexes in that area. There's almost none. Apparently, I didn't know that myself.
Just for reference, so we can give some people listening, like what Randy and Drew are talking about is, so you're talking about forced appreciation. Little background is in multifamily, it's considered like a business. So your property value is based off NOI, right? So NOI by cap rate will give you the purchase price and stuff. So if you improve your profits, your property will be valued more. They don't care if the next house is a mansion or not, because this is a business. Now, when you go 1, 2, 3, 4 units and you're using, comps or comparable sales, what happens is they want to see what the neighbor's house sold for in a vicinity. So for us, we bought a property, a duplex, for $900,000 in a year ago, and then we appraised it recently, and then they said it was worth $850, and I was like, okay, so this is Orange County. The comps say it has gone up by 7%. It should be $970, not $850. This makes no sense. And they were like,
Wow.
well, we pulled a comp from, I don't know, like a year ago, and it's not even a duplex. I'm like, these guys are just insane. Like, this doesn't make any sense. So it's just like opinion. It's like broker's opinion.
Yeah.
Like, I think it's worth ₹5. Like, it's
Something to note is there's incompetence
Yeah.
on every sector, on every level, and everything. So just keep you ready
Another
for
appraisal.
Yeah, it's just didn't appraise. So luckily for us, like unlike Randy's, all these multi-million-dollar deals, these are all fixed rates. Even though they were higher, the rate doesn't go up, so we can hold on to it. And we have a reasonable portfolio size, so we can take some losses in some properties because the other properties bring in more money. So it's very interesting.
And you can refinance those properties and
For
take
free.
equity out.
There's no prepayment penalty.
There's
That's
no
another
prepayment.
thing with
with multifamilies. That's not a thing. Again, I don't know.
Well, so it depends on what kind of loan you have. So, for example, it gets super interesting and complicated at the same time. So, for example, let's say if you take, when Randy's talking about it's a fixed loan, there's no such thing as a 30-year fixed loan.
Right.
Maybe there is, but nobody's using it. It's either 3, 5, 7, or 10. Now, if you take a 10-year and you fix it, you're like, wow, I'm really smart. Are you? Because now you have to pay a 5 points free penalty if you want to refinance and sell the property.
Oh, and you have to do that with.
So now Randy's got to sit here with his nerd friends and be
I
like, bro,
see.
so we're thinking of a 3-year exit. So let's just fix it for 4 or 5 years. And then if he misses it, now he has to refinance. It's a whole different deal.
So you're really thinking like a chess player, like super long term. You
Yeah.
exit every year. Okay, wow.
Because that'll cost you money. Like you
Right.
lose $1 million.
Yeah,
Like they tell you it's a 1.2 points, 3 points.
yeah. That's interesting.
Is that accurate, Randy?
Yep, you hit it on the head. You could teach the class. But I think going back for your listening audience, I just want to pause on that concept of NOI or net operating income. It's very simply, it's income minus expenses. And so the way you improve that is you either raise rents, you raise income, or you reduce expenses, or both. And the mathematical equation is you're going to improve NOI by doing that. And by doing that, you raise the value of your property, regardless, as Vince said, where it sits. And that's the magic. And again, commercial real estate is generally 5 units or greater. Anything less than 5 units is residential. So that's why I would assume your duplex, why it's the bank doesn't consider it a multifamily per se.
Right.
They consider it a residential. And so what I've been told anyhow is 5 units and greater are commercial grade properties from the lender's perspective, and less than that are considered residential.
So what were some of the things that you've done on that? I'm still kind of in my brain on the second deal.
So what you do, every acquisition has a business plan. So we set about a business plan, and generally speaking, it's called a value add. So you're trying to, as this GP, you're trying to add value to the investment group by increasing rents. So how do you increase rents? Well, you make room improvements. You add new amenities, a dog park, whatever else, washer and dryers, the covered parking, put up some garages, and that allows you generally to increase rents.
Mm-hmm.
You're reducing expenses. You're trying to take the prior property management's team and find out where they didn't competitively bid lawn mowing, landscaping,
right.
Roofing repairs. And so you're generally trying to find property management companies that have a big vendor list that you can leverage and start to negotiate. So, I mean, it's just really simple. Increase revenue, decrease expenses.
It's a business.
But it's an art form to do that.
Sure. Yeah, it's very nuanced.
Mathematically, it works.
Right. But it's nuanced. It's like, it's people, it's EQ just as much as IQ.
To make this even way worse, so you just die out of just nerdness, is we haven't even talked about the mortgage in NOI and expenses. So the mortgage, which is principal and interest, does not come into the formula for NOI calculation, right? So you're like, oh, okay, so why does the mortgage rate matter? Well, because there's something called the cap rate, which is what the market is willing to pay for your property. And as the interest rate climbs, people are not willing to pay as much. So then your cap rate rises, which brings down the value of your property. So you could just underwrite all you want and be like, oh yeah, we're buying it at 5. We're going to sell it in year 5. It's going to be a 1 cap. So the property is worth $50 billion. Right. No, the interest rate went to shit and it's now 10 cap and you lost all of your.
So the interest rate for the U.S. economy is extremely important factor.
Yes.
So you really have to think macroeconomics before you enter a deal. Are you going into that level? Or are you just hoping for the best? What's
No, it's all about Vince. Right, you're looking at there's an inverse relationship between cap rates and asset values. Mm-hmm. So if cap rates decline, property values go up.
Right,
and cap rates, not interest rates, but cap rates. If cap rates go up, property values go down. Mm-hmm. And we're in a period of cap rates increasing right now. So depending on what market you're in, you always want to try to find, generally speaking, you're trying to find a buy where the cap rate is less than the interest rate. It's called the spread, is what you're trying to seek for. But it is challenging right now with increasing cap rates. Wasn't too long ago, like when we did that first Beaumont property, the value we put into it was room improvements, putting up new units from the fire. And we were raising rents $200 a unit. Wow. And so the NOI was just climbing. And that just created an immense amount of property value. It gets tougher in this current environment, but can still be done. But that cap rate that Vince takes to is crazy and kind of varies between areas, but it is, generally speaking, the way I've heard it defined, Vince, you correct me, it's what an average investor would expect as a return in that area. So if I'm in California, it's probably got a lower cap rate than St. Louis.
Like if you just look up, like, just this is very on the surface. If somebody is selling a property for 1.5 cap and then another guy is selling a property for 10 cap, I could, without looking at it, tell you 1.5 is in Newport Beach and the 10 is in Bakersfield shit show. Like that's how.
Hey man, I like Bakersfield, bro.
We bought in Bakersfield, so we can talk about Bakersfield. We had like a multi-million-dollar portfolio.
Yeah, that makes sense.
But that's because the guy who wants to invest in Bakersfield is expecting a bigger return, because I'm doing all this work, bro. I don't want a 1% return. This is garbage. Right. So then you can, go somewhere else. Yeah.
Yep.
And it's more risky in Bakersfield.
It's more risky in Bakersfield.
That makes sense.
Yeah.
So I'm sure the state level, every municipality down all the way to the city matters. To the area of the city matters.
Yeah. Oh, yeah. You got it within the city. You take a city like, I'm sure LA, or I'm in Houston, and yes, that cap rate will vary in each of the different regions of Houston. Greatly.
Let's do a pop quiz, Randy, for Drew.
Oh, here we go.
If you have a 5% cap rate and you're borrowing money at 7%, what's going on?
I don't know. Tell me.
Come on, man. Give us an answer, so it'll be fun.
Now, what's the answer?
Well, the answer is if you do that deal, if you bought it with cash, then you don't really care. But if you levered your money, or if you use leverage, all of that money that you borrowed as debt, you're losing 2% on that money because the property is not bringing in enough money to support that debt. So now,
you have a 5% loan.
If you have a 7% loan and
7% loan,
if your cap rate is 5.
Oh yeah, that makes sense.
You're basically
negative,
praying for a better day.
Yeah, you're praying for a better day, and you're borrowing money from investors, and you're giving them 8 pref. That's what is like technically and officially termed as a Ponzi scheme. You're just borrowing more money from the investors, just paying them back the same.
Got it. But it's a variable rate though, so you're saying 7% for how long?
Yeah,
it can be a variable rate. Can be a
exactly.
Rate.
So that's like yet another fact. You know what, guys? I'm out. Like I had a great time.
You see why we didn't go with the multifamily? This is why.
Oh, that's a lot, dude. Yeah, I need to do some reading for sure. I appreciate this whole podcast is like me asking questions. Like, well, what is it? How does this work, guys?
But most people will ask questions like you. That's why it's good.
Yeah, that's great.
Well, and your audience is, I'm probably sure, all over the board too. But the big difference for me, the takeaway is in a larger multifamily, bigger than 5, you can get fixed rate debt. It is dependent on the area and what the cap rate is and what the interest rate is, but you can still find them. It's hard, but you can find those projects and you can buy it on a non-recourse basis. I would assume those duplexes and stuff you're buying are all recourse. You're at risk if they go under.
I have my kidney on the line on every deal.
Yeah, we got it appraised last week. My liver came in. I'll have to owe more money.
They looked at his liver and they said, "No, not with your last name."
Oh, I don't think
freaking German, Irish.
Yeah, German and Irish. Yeah. Oh my goodness.
More than nothing, they threw it away.
This is fun. How are we doing on time? I want to make sure we're respectful of your time. We have.
I'm fine. I'm fine. You guys are cracking me up, man. That's great.
Now, okay, Randy. So here's what I want to do. It's very hard to get all in an hour, right? So we got the website stuff, but I wanted to ask you, for people listening and they're like, all right, bro, you guys are talking about 50,000 units and 1,500 doors. They're already tuning off right now. So I want to stop those guys tuning off and be like, it is August 2024, pretty soon. What should people do? If the guys, someone is looking at a deal, should they do the deal? The feds are going to cut rates in September. So wait till you cut rates, wait till next year. Wait till your mom's 100. Like, what's the deal? What do you?
So, my response to that is I get the question asked about. So this is not a good time to buy. I says, well, I guess I'm of the opinion that I'll buy in all markets, up, down, and sideways. But with the qualification that you buy very differently today than I did a year ago or even 6 months ago. And the biggest difference today is I think people have to take action because there is always going to be a billion reasons why not to invest. Might be Iran-Iraq war, Chinese are going to invade, dollars going to the tank, et cetera, et cetera. But you got to take action. Sooner or later, you got to decide what you want to do. And if you're not going to invest, put it all in the stock market and good luck. But you got to take action. I think you buy in all markets. You just buy very differently. And there's a lot fewer deals being done today and a lot different deals than they were 12, 24 months ago. I'm sure that's both on the smaller side, the 2, 3, 4 unit properties, as well as the 100 unit properties.
We started in 2018, Drew and I, and we started in Bakersfield. You know what? Everybody and their mom and their dog called us and told us, the market is overpriced. You fucked up. You should have never bought in this. It's going to crash. And they're all living in their mom's basement in 2024. They're still waiting for the crash.
Yeah, I mean, I still get
Yeah, you can keep talking.
People saying, "Oh, like you're buying." We literally just had a friend say you're buying too many deals. I don't mean to go down that road, but yeah. So there's always going to be criticism. However, here's my advice to anyone listening, and I know Randy will back me up as well as Vince. If somebody's not doing and achieving the results that you want, then you should not listen to that person. Like if they are doing well and the results are in, you need to find a way to give them value, get on the phone, get on an LP side, buy their coaching, get to be a part of their ecosystem in some way because they actually have the answers. They've gone through the fire. They are still going through fires, sometimes literally. And it really is important that you understand that everything that you want to do, if you want that financial freedom, like we're about to be in Europe, I'm be able to stay there for as long as I really, truly want, technically, which is kind of cool to say out loud. And it's because I made these decisions years ago because I wanted this. This was in my brain a long time ago. And so I made these crazy, huge risks, bigger than most people, not as big as Randy, 1,500 units, all different level.
Can we deal with the fire?
Yeah. But the point is I knew that I would just need to just jump and be okay with being afraid and take a risk and just roll up my sleeves if I had to do it myself. Here's something I would say, you guys. Really define what you want and be prepared to work twice as hard for it and to spend twice as much cash. And that's just with everything. And prepare to know that you will read a book, you will get mentoring, and you will always feel dumber afterwards because there's so much, there's so many nuances. So find your thing, find your niche, find what works for you. There's so many ways to make money, to create financial freedom in real estate. You just got to educate yourself enough and really make sure it aligns with not only your goals, your risk tolerance, but also your personality. For me, I like people, I like teams. For the Airbnb thing, I found that I kind of had a niche for that. That's my lane. He's the numbers guy. He knows the cap rates. He's going to be the reason why we get into multifamilies eventually. But I'm going to have to make sure that I'm educating myself because he's going to be dragging me up through it if I don't. The point is take your time, talk to guys like Randy, take their programs, talk to us, pick our brains, come to our meetups, get into the room.
Take the long view. Take the long view for your audience too. I mean, everybody has challenges. It's not, trees don't grow to the sky, as they say. It's not always uphill. Always roses. My point of this is it's a business. There are challenges.
Yep.
And like you said it very well, Drew, just stay in the game. Persistence, education, stay in the game.
Yeah, I always tell people if you have the means to hold on to the property, then you should do the deal, even if people are not paying as much rents as you thought and all that. If you can, then it's good. That's why a lot of people, like our friends, they're like, "You're buying too many deals, mate." Like it's like, yeah, because they don't quite understand like what we are in it for. Like we can eat a lot of crap for a long time because we have means to do that. So we're not playing the simple game of, oh, well, I got $10 today, and and I paid $8. We're playing the appreciation game, and we've come out on top, right?
Yeah.
So in that regards, Randy, you said there's never a good time to buy. I agree to that. There's always something going on. There's always a Israel war and China and Russia every day, right? There's something going on. So when you say you have to know your things to buy, what is that? What does that mean? Like, do you have to know what? Like, what do we need to do to evaluate it's a good deal or not?
Yeah, and I think that's part of the educational process. You don't just start out. You guys didn't start out buying duplexes or quads without some knowledge or a mentor. Maybe you did, but you were foolish if you did, I guess. But
no, we are idiots. Randy said it first. Vincent Drew, morons.
Well, sounds like you're making a lot of money, so you got the last laugh on me.
Yeah.
But I think looking at deals today, it's about, for me, it's about the team, the sponsorship team. Who's doing the deal? You guys are the sponsor on smaller properties. People have to know you two, know your business model, your plans before they invest. A lot of people don't do that. I call it speculation. They just throw money at you guys or at me because they like Randy or they like you guys. Investors, limited partners should educate themselves, learn the business risk from your model, my model, or anybody else's. Understand those risks. That's called investing. And so I can talk multifamily all day long and would happy to do so, but learn the risk, know what you're getting into, and don't invest if you haven't got the money to lose. I mean, that's the other thing. I know people going out and leveraging their primary residence, and
right.
I discourage that. Don't do that.
I get asked, this happened literally last night. A friend came over, we're going to some comedy show, and he's like, well, I might have, 50,000. I've been watching you guys grow, and I really I want to get back in on the game. He's one of those guys that lost his primary back in 2009 or whatever it was. And so I kind of was like, well, what we got going on? And the point is if it's your only $50,000, that's your savings, don't do the deal.
Yeah.
Like, it is a risk. So hold on to that, have some liquid, whatever that risk tolerance is to you, like I was saying before. But you're right. You need to make sure that you're willing to lose it as well. Now, of course, you do your due diligence and you're doing your homework. It's not speculation, it's investing, and do it wisely, but there will always be a risk. And if you're going to do something with multifamily, Randy is your guy. Show notes, check them out. Is there a website that we can plug?
Yeah, there's two of them. I'd like to plug the Multifamily Maestros, all one word, multifamilymaestros.com. That's the mentoring program. My personal or my business, invest-ark, invest-ark.com. And that's both of them have contact me pages out there. Love to chat with your audience.
Awesome.
About anything, quite honestly.
Wonderful. So yeah, anything multifamily, Randy's your guy. And then on that note, if you want to do something like with like what we're doing, more of like the residential side, 2, 3, 4 units, getting into the Airbnb sphere, especially, that's us. Reach out to us. But definitely get educated. Go to meetups. Free meetups that we do are always free. We always just, I don't even know. Usually I don't know most of what I'm going to talk about. I've got like an outline, an idea, and I just go, and Vince goes, and we're just shotgunning value. So get into those rooms. Guys like us are excited to help. I like to help others. I like to give back in that way. Now that we're experiencing some of the success, it's lonely at the top. I want my buddies to do, just as well. Let's all travel to Spain together, which is literally what we're doing, by the way, with a couple other successful buddies, which, man, I'm excited about. So sorry.
You guys take care of your kidneys and livers over there.
Yeah. Thank you, man. Vince, any last words? I don't want to take too much more of Randy's time. I felt like we've really extracted enough. I'll Zelle or Venmo you later. Advice.
Yeah. No, I think I'm good, man. I think, Randy, you have any last things to say for our listeners trying to get into the game?
Well, again, you got to do it. You got to take action at some point, whatever that action is. And the second one is just to thank both of you guys. Hey, it's been a lot of fun. Really enjoyed it. And the comedy act of you two is pretty good too. So
yeah, we're like this 100%.
This is all we do all day. Like it's always this way.
If you're ever in Orange County, Randy, hit us up.
Come by.
Hey, likewise, if you're ever in Houston, would love to buy you a meal sometime.
I just had a layover in Houston that I got stuck, and I wish I had met you before because I was stuck there for a night recently.
Well, I hope it doesn't happen to you again, but if it does.
You're on speed dial now, bro. Thank you so much for your time, Randy. Really appreciate you educating our audience and myself on all things multifamily. Hope to see you again and catch up maybe in a year or so and see how your company's grown even more and you've even experienced even more success, not just with your portfolio, but with your coaching as well.
Thanks. Appreciate it, guys.
Thanks, Randy. That was good, man. That was good. We'll let you know when we put it up.
Thank you. I don't know about you, but I definitely like to see 5-star reviews on any service or any product before I purchase. Please take a second to leave us a 5-star review, whether you're listening to it on Apple, iTunes, or Spotify, or whatever platform. Take a second, goes a long way, helps us a lot to grow the channel, and thanks for listening.